Hi, everybody. Welcome back. Today, we are going to talk about the macroeconomic idea of exchange rates and international capital flows. And this is really great because what we've been doing in the last couple of chapters is really digging into how countries interact with each other by looking at trade, right? The balance of trade in exports and imports, and then connecting it to capital flows, how we pay for that, and demand for financial capital from other countries. And so today we're going to talk about the market for currency, right? The idea that currency, dollars, euros, pesos, won, renminbi, all have demand and supply also. And that's going to be really closely tied to a lot of our macroeconomic ideas, whether we're talking about the idea of buying goods and services from other countries, whether we're talking about sort of how our country is viewed and our currency is viewed in terms of its riskiness, its worthiness, and how countries manage their currency. So we'll be talking about different kinds of exchange rate regimes. And we're going to get a lot of terminology there too. So we'll be talking about things like appreciation and depreciation when currencies increase or decrease in value relative to each other. We'll be talking about the market for the foreign exchange market. And we'll be talking about these different kinds of exchange rate regimes, pegging currency, what's a soft peg versus a hard peg, and those kinds of things. So let's get started. I'm really excited. I've got a little baby graph down here of showing the market for euro. And so you can see, right, there's the quantity of euro and then dollars per euro. And that's how we're going to be doing this work, is we're going to always be looking at one currency relative to another. And that's going to help us to understand this stuff. So grab your textbook, grab your notes, grab your slides, and let's get started. Okay. So as we get started here, we're going to look at a couple of different subsets of the exchange rate market and international capital flows. First, we're going to talk about how the market for foreign exchange works and sort of define that market and sort of what our expectations are of it. And then we're going to talk about the demand and supply shifts in those foreign exchange markets, what can cause them and what the effects are. And then we'll talk about the macroeconomic effects of exchange rates, and then we'll wrap it up by talking about exchange rate policies. And that's where we'll talk about the different kinds of exchange rate regimes that countries can use to try to manage their currency relative to other countries. So this is all getting back to this larger question of what is good for a country. And this is macro, right? So when we're talking about macroeconomics, we're always going to be talking about what's the best thing for our country. And there are a lot of ideas and conventional wisdom about what's good or bad. But the reality is that a lot of this stuff is a little bit more nuanced. And so we really want to dig in to exchange rates, capital flows, and trade to get a better sense of where our country is and where other countries are and what we can do to sustain our economic health. And so we've asked this question before: are trade deficits good or bad? And it's going to depend on a lot of things. And one of the things we want to remember is that when we buy stuff from another country, that's going to involve the flow of financial capital and the exchange of one currency for another, because we all have our own currencies in different countries. So first, we want to talk about some of the big ideas, some of the big terms that we're going to be using. The first one is the word dollarize. And this is actually a pretty fun word because it sort of means what it sounds like. It's when a country that's not the United States uses the US dollar as its currency. And this doesn't happen all the time, but if you go and take a look, actually, let me show you. Hold on one second. So dollarization is using the US dollar. More broadly, this is known as currency substitution. So you can use another country's currency instead of having your own. And we'll talk about the pros and cons of this a little bit. One of the things it does is it sort of takes away your right to sort of self-determination with respect to monetary policy, which we're going to get into, I promise. But I just thought this was kind of a fun little aside. So this is just a Wikipedia page that kind of goes through some of the countries that end up using some currency substitution. And there's a lot of detail here, but you can see there are some countries that use the Australian dollar, countries that use the euro that are not members of the European Union, countries that use the Indian rupee, countries that use the New Zealand dollar, the British pound sterling, the South African rand, and then here are the countries that use the US dollar either exclusively or with other currencies. And so we have our own term because we're the US, and so we're going to talk about our currency, but also we see a lot of US dollars used throughout the world. And so a lot of exchange is done in US dollars. And you might have seen this if you've traveled to other countries, even in places like Mexico. Sometimes you'll see, especially along the border, people willing to exchange in either Mexican pesos or in US dollars. And we see that in a lot of other countries as well. So I think that's kind of an interesting example. Here's some other ones down here. So I just thought that was a fun thing to see. You can always kind of pull this interesting information out. It's all available online, and it's a nice way to connect with the material. Okay. So back to our slides. So dollarization is just a country using the US dollar as their currency instead of having their own currency. And it's part of this sort of broader system of currency substitution. We also are going to be talking about foreign exchange markets. And I've already talked about it a little bit, but the idea is it's a market for currency. So we're going to be talking about the price, quantity, demand, and supply of currency, whether it's US dollars or any other currency. And I wish I was cool and had other currency here, but we can, think about the idea of going to a place where you buy US dollars. Before we had so much digitized money, it was a lot more common to have to go and buy currency if you were going to travel internationally. And the exchange rate is just the price of one currency in terms of another currency. So it's how many dollars does it take to get to $1 in euro or something like that. And so what we want to think about here, it's going to be confusing because we're going to be talking about two currencies. One's going to be the price and one's going to be the good. And so try to just keep it slow and simple in your brain. And I find that if you take it easy, it helps a little bit to make it make sense. So we're going to be looking at exchange rates in the foreign exchange market and how the supply and demand of currency can be affected and determine those exchange rates and what that means for a country's economy. The foreign exchange market is the largest market in the world. In 2019, it was about $5.3 trillion per day being traded in terms of buying and selling currency. This is, if we compare it to the US GDP in that same period, our total GDP for the year was $21.4 trillion. So it's a really, really, really big part of the international economy. And so it's important for us to talk about it. So we generally could think of four types of people or four agents, four entities that participate in the foreign exchange market. It's going to be firms that are going to be buying and selling, trading goods internationally. So they're going to be buying and selling currency in order to buy and sell those goods. We're going to see tourists, people traveling from one country to another. They're going to need to consume currency, buy currency in order to make exchange. So if you travel to Bhutan, you're going to have to go and buy some currency. Usually they have places at the airport or as you enter any place where there's lots of tourists around. We also see international investors who are buying or participating in the ownership of a firm. They're going to need currency. And then international investors who are making other types of investments. So maybe not necessarily buying stock, but doing some kind of other investment. So basically, if you're going to be interacting with another country, you're going to need currency to do that. And that means you're going to need to buy some of their currency with your currency. When we think about it from the firm's perspective, if you are going to be buying and selling goods, if you're going to be exporting and importing, you're going to see that sometimes your costs, the costs of your workers, your supplies, your investors, your investments, they might be measured in the currency of the other countries you're working in. And your revenues might also be measured in the currency of the other nation. So if I am exporting pens to Korea, I'm going to need to know how my revenues are measured. It's not going to be measured in US dollars. And I might have some fees and taxes associated with that export that are also measured in another currency. And so it's going to be important to both consume the currency and have a sense of the currency. In terms of financial investment, we see that financial investment can cross international borders, and it's going to also require the exchange of currency. And there's two main kinds of investment that we think of when we think about international investment. The first is foreign direct investment, or FDI, and that's when you purchase a portion, at least 10%, or even the entire portion of the whole company in another country. So that would be like if I started a business in another country, that'd be foreign direct investment. Portfolio investment, on the other hand, is investment in another country that is purely financial and doesn't involve any management. And so the difference between foreign direct investment and portfolio investment is, am I running a business in another country, or am I just sitting some money there and hoping to see a return on that investment, right? So it's kind of like the difference between buying stock in a company or running the company, just across international borders. The other new term we want to think about in this section is the idea of a hedge. And hedge is something that we use a lot as a term in financial transactions. And it's basically just a way to protect against risk. And so you'll hear the phrase hedging against risk or hedging a bet. So the idea is, if I'm worried about a risky investment, I might put some of my money in a safer investment to hedge my bets, to protect myself from some risk. And this is relevant because as we start to talk about exchange rates, we're going to see there are a lot of factors that can contribute to fluctuating values of currency. And so we're going to see investors looking at how to hedge their risks associated with that. So think about a normal traditional investment. Let's say I want to buy some stock in a company. I want to buy Apple stock. Apple's doing well. I can assume it's going to continue to grow. But things change, right? The stock could go down. So there's a certain amount of risk associated with any kind of investment. When you're investing in a company in another country, there's a second level of risk, because as we're going to talk about in this chapter, you can see fluctuations in the exchange rate that can lead to currency loss. So if today I take my dollar and I invest it in another company in another country, the return on that investment is going to be denominated in that other country's currency. And so if the currency grows relative to the US dollar, that's one way that I can see my investment change, in addition to the investment changing just based on the value of the project. Hopefully that kind of makes sense. We're going to talk about it more. We're going to talk about it a lot more. So let's look at this. This is a nice little infographic from your textbook, and it's trying to kind of outline how a portfolio investor might benefit from exchange rate movements. And this is kind of what I was trying to explain. So we have an international investor who expects that in the future, the British pound sterling will buy $1.60 in US currency instead of $1.50. So they're hoping that the US dollar's purchasing power relative to the pound is going to change. They think that the pound is going to buy more dollars in the future. So they can take $24,000 of USD and convert it into British currency. And then when the British currency increases its value, it's now able to buy more US dollars. When they convert it back, they earn a profit. So when they take their 16,000 pounds and convert it back into US dollars, now that the exchange rate has changed, it's no longer 24,000 US dollars, it's 25,600 US dollars. And so exchange rates and currency markets can be a way to make money, and that's part of what we're talking about here. We could also see an international investor expects the pound will buy less US dollars in the future. And so then what I'd want to do is take 20,000 pounds and convert it into US currency. And then when the US dollar falls relative to the pound, I convert it back into pounds, or I convert the US dollars back into pounds and earn a profit. And so the idea is, if two currencies are fluctuating in relationship to each other, if you can predict the change in the fluctuation, the direction of the fluctuation, there's a way to make money. Expectations about the future value of a currency can drive demand of for that currency and the supply of that currency in these foreign exchange markets. And so that's one of the big forces that we're going to see driving exchange rates. In order to participate in the foreign exchange market, you're going to need to have some kind of entity that is processing that exchange. These are called foreign exchange dealers. They're banks and other firms, other entities that trade in foreign currency in the interbank market. And there are about 2,000 firms in the world that are foreign exchange dealers, and the US economy has less than 100 foreign exchange dealers in here. Most of these foreign exchange markets are for portfolio investment. So remember, that's the kind of investment where I'm not managing the company, I'm just giving the country or the company or the firm my money and hoping for a good return. The foreign exchange market is going to involve firms, households, investors, anybody who wants to demand or supply currency, and they're going to work through their banks and other foreign exchange dealers to buy and sell currency for investment and for returns. So when we're talking about exchange rates changing, again, we're always going to be talking about one currency in exchange for another. We're going to tend to use the terms appreciating and depreciating. Appreciating or strengthening is when an exchange rate rises relative to another currency. So in the example with the pound sterling and the US dollar, the first example, the US dollar was going to appreciate. It was going to go from being worth, well, the pound was going to go from buying $1.50 to $1.60. On the other hand, the second example was a depreciating currency when the exchange rate falls or weakens. And so that pound sterling would go from buying $1.50 to only buying $1.40 in the future. Does that make sense? We can look at the fluctuations of appreciation and depreciation in currency, but again, we're going to need another currency to compare it with. So here we can look at the currency's fluctuation of US dollars, the exchange rate of Canadian dollars for US dollars and US dollars per Canadian dollars. And so if you look really closely, you'll see that well, first of all, this is a little confusing because the graphs are not over the same time period, which seems a little crazy to me, but it is what it is. And also, depending on the version of the textbook you're looking at, you'll see different variations. So my textbook goes from 1980 to 2016. This goes from 1984 to 2020 and 1974 to 2020. But what you can see is Canadian dollars, how many Canadian dollars it takes to buy a US dollar rises and falls with different economic changes. How many US dollars it takes to buy a Canadian dollar will also rise and fall. And it should be in exact inverse because we're talking about how many Canadian dollars does it take to buy a US dollar on the top graph, and then how many US dollars does it take to buy a Canadian dollar. And you can look all of this up at the Federal Reserve website and see this kind of data pretty easily. So, how do exchange rate movements affect different groups, right? We're talking about all these different groups that are buying and selling currency and dealing in currency. And it's going to have different effects for different people. And this is why it's complicated, right? You can't just say, oh, a strong dollar is good or a strong dollar is bad. It depends on who you're talking to. So exchange rate movements are going to affect exporters, tourists, and international investors in different ways. If you are selling goods to other countries, a strong dollar is bad because that means that having your goods sold in US dollars is going to make it more expensive for other countries. On the other hand, if the US dollar depreciates, is weaker, then your goods get cheaper without you having to change your prices. If you are exporting to the United States, then a US dollar is good because it means you're going to be getting more money for your goods. But as the US dollar weakens, you're going to get a lower price just because of the purchasing power of the dollar. If you're a US tourist traveling abroad, a weak dollar is bad because other people's prices look higher than your prices, but a US dollar being strong and a US tourist traveling abroad is a good thing. So if you think about, again, I'll use this example because I think a lot of us in the US, especially in California, are more likely to have traveled to places like Mexico and Canada. If you've traveled to Mexico, usually the US dollar is stronger relative to the peso. And so things are kind of cheap and it's nice. If you travel to Canada, it's been generally historically true that the the Canadian dollar is a little bit stronger than the US dollar. And so you feel a little poorer, if that makes sense. We can see the same thing for US investors versus foreign investors. So if you are a US investor investing in other countries, a weak dollar is going to mean you're going to get a better investment, and a strong dollar is going to make it harder to invest in other countries. And the opposite is true for the foreign investor trying to invest in the United States. A stronger dollar is going to mean a greater return relative to a weaker dollar. So now we want to talk about the demand curve and the supply curve in the foreign exchange market. And basically what we're going to see here is that it's all going to be driven by expectations. And so the idea is that we're going to see individuals demand more currency when they think the value is going to increase. And at the same time, you're going to supply more currency to the market if you think the value is going to decrease. And so the idea is, if I think this dollar is going to get more valuable in the future, I'm going to demand it. If I think it's going to get less valuable in the future, then I'm going to supply it, try to get rid of it. Does that kind of make sense? So we can put it together in a graph. And again, this is a little confusing, but if you take your time with it, I think it helps. So we have US dollars and US pesos. Mexican dollars and US pesos. And what we want to do here is look at the market for the two currencies next to each other. So the first market we have is going to be the quantity of US dollars traded for pesos. So our quantity is US dollars, and a price of a US dollar is going to be in pesos. And so we can think about how many pesos does it take to buy a US dollar. And we have some demand curve and some supply curve. Well, that's not a very good demand curve. There. Goodness gracious. I can't draw a demand curve today. All right, so we've got our demand curve. That's not much better. And our supply of US dollars. That's kind of better. I think that pen might be toast. And so we're going to have some equilibrium quantity of US dollars and some price indicating how many pesos it takes to buy a dollar. And so in this case, we're using an exchange rate. We're getting an equilibrium where the demand for US dollars is equal to the supply of US dollars, right? Where quantity demanded is equal to quantity supplied. We're going to have an exchange rate of 10 pesos to buy a US dollar. Oh my goodness. Okay. And on the other hand, over here, we're going to have a quantity of pesos. And how many US dollars does it take to buy a peso? And we're going to have a demand curve for that. So that's way better. And a supply curve for that. And where quantity demanded of pesos is equal to quantity supplied, we're going to get an equilibrium quantity of pesos. And there's going to be an equilibrium exchange rate. And in this case, we kind of already know, right? If it takes pesos to buy $1, how many dollars does it take to buy 1 peso? It's going to take 1/10, or if we're measuring it in USD, we can just say 10 cents, right? So the exchange rate is revealed on both sides of the market. So 10 pesos to $1, or 1/10 of a dollar for 1 peso. Make sense? And then we have our quantity equilibrium, and the idea is that these pesos and dollars are being exchanged for each other in markets around the world. And then what we want to think about is that these quantities are going to be determined by, and the exchange rate is going to be determined by expectations. And that's what's going to be the main force driving these currencies. Expectations about the strength of the economy and expectations about the future of the currency. So like we talked about in the beginning, right? If I want to invest in a business in Mexico, and I think Mexico has a lot of growth potential, if I think the currency is going to appreciate, those kinds of things are going to make me want to demand more currency, right? And we're going to see these currencies adjust in both cases to those expectations. And so this graph gets a little bit wild, but you can see there's two different things happening, right? So we start out with our initial equilibrium, our demand and our supply. The first thing that could happen is we could have an announcement that the peso is probably going to strengthen in the future. If I think the peso is going to get stronger, then I'm going to demand more pesos. And that's going to shift that demand curve out higher, right to the right. At the same time, it's going to make investors less likely to give away their pesos. They're like, wow, pesos are going to go up in value. Those of us who have them are going to keep them. And those who don't have them are going to want to buy them. So we're going to see the supply shift in. And so what that's going to do is have the effect of appreciating the currency. Now it takes more dollars to buy 1 peso. So now maybe it's $1.40 to buy a peso when it was 10 cents before, or I guess in this case they changed it to $1.20. All good. So both shifts are going to happen at the same time because of the same expectations. They're going to cause the right shift and the left shift, and it's going to appreciate the currency. The other side could happen too. We could see that we could have depreciation in the currency driven by expectations, and that would give you the second effect, the second set of supply and demand curves. So if instead of expectations about appreciation, we had expectations about depreciation, I'm going to put my curves back in there, and I thought that the peso was going to depreciate, then I would demand fewer pesos, and people would be more willing to supply more pesos, and we would see a lower exchange rate, depreciation, maybe down to, instead of 10 pesos for a dollar or a tenth of a dollar for a peso, maybe it'd go down to 5 cents, something like that, okay? So expectations are going to play a really big role in these foreign exchange markets. We're going to see that there are going to be a lot of differences in rates of returns from country to country. The motivation for any investment, whether it's direct or not, whether it's investment in we'll talk about different investment debt instruments, but whether it's investment in a company or an investment in a currency, it's all about getting a return. If the rates of return in a given country look high, then that country is going to tend to attract more funds from abroad. So what we see a lot of times in the discussion of economic development is, how does a country attract economic development? Well, you have to look like you're going to give a good rate of return. On the other hand, if the country looks like it's not going to give a good rate of return, then they're going to tend to see currency, see investors flee. This is one of the effects of like political or social strife, right? If it looks like there's something else going on and businesses aren't safe in that country, then investors are not going to want to put their money into businesses there. They're going to want to put their money someplace safer where there's a better return to be expected. So changes in the expected rate of return are also going to alter the demand and supply for a currency. If I think that now is not a good time to invest in Mexico, I'm going to demand fewer Mexican pesos, right? And I'm going to be more willing to supply the ones I have to the market. On the other hand, if I think things are going well, then I'm going to say, oh, wow, I would like to demand some Mexican pesos so I can invest in this growing economy and get in on that rate of return. So here we have an example of the United States, and this is people trading pesos per dollar. And we can see that the exchange rate market is going to react to our domestic macroeconomic conditions. So in the United States, we've been dealing with a lot of higher interest rates. Higher interest rates usually mean that holding US dollars is going to be more attractive because remember, interest rates are the benefit of saving and the cost of borrowing. And so if interest rates are high, that means that I could loan companies money and make a lot off of it. So I'm going to tend to demand more currency and be less willing to supply it to the market, meaning I'm going to tend to see higher exchange rates or exchange rate appreciation relative to before. So if we are experiencing higher interest rates, it's going to lead to expectations of greater rates of return on investment. That's going to increase demand and decrease supply, appreciating the currency. Cool? So far, so good? If we have relatively low inflation, we're going to see the other side of things, right? Low inflation is going to tell us that we are expecting the buying power of that currency to be eroding. There's not a very great rate of return on investments and lending, and that's going to discourage people from wanting to hold or acquire the currency. And what this is getting to is one of the big universal truths of economics, which is there's no perfect number of anything, and even if there is, it's rarely zero. So there's no right rate of inflation. There's just there's argument about what the right rate of inflation is, but it's never zero. So if a currency is experiencing relatively high inflation, then the buying power is going to be decreasing. So in the United States, we're experiencing pretty high inflation right now, or we have been in the end of 2022 and most of 2023, there was some pretty high inflation. And so if we start out with an equilibrium demand, I hate writing in black. I'm very picky about my graphs. So if we start out with some equilibrium demand and supply of US dollars in terms of pesos, high rates of inflation mean that the purchasing power of a dollar goes down, right? As inflation goes up, prices go up. So the ability of me to pay for this with $1 has gone away, and now it's going to take $2. So the purchasing power of this $1 got smaller. So that high inflation means that a dollar buys less, and I don't want that. I'm going to demand fewer of those dollars and be more willing to supply them to the market, which is going to depreciate the currency. Does that kind of make sense? So all of these factors are going to have an effect on exchange rates, right? Rate of return, interest rate, inflation rate, all of those things are going to drive it. And this gets to another idea. The first thing we want to think about is this idea of arbitrage. Arbitrage is just buying and selling things across borders in order to take advantage of different prices, which sounds complicated, but there's like a really simple version of it. One of my favorite examples of sort of a mini market is when you go to a concert or a sporting event or even just a movie, and the food and the drinks are so much more expensive inside because they assume you can't engage in arbitrage, right? Arbitrage in this case would be bringing in outside food. They know they have you as a captive market, and so they can charge a really, really high price. But if I was able to come in to the movie theater and sell popcorn for $1 a bag, I would make a lot of money. The idea of arbitrage with respect to currencies and goods and international trade is the idea of saying, oh, well, I can buy insulin in Canada for a fraction of the price, drive it down to the United States and sell it for a markup and take advantage of those price differences. And so arbitrage is just taking advantage of those price disparities across some kind of border to make money. Purchasing power parity is fun to say because there's a lot of P's, but it's the exchange rate that equalizes the prices of internationally traded goods across countries. So it's the idea of saying, okay, it takes 10 pesos to buy a US dollar, but does 10 pesos buy as much as $1 does, or does it buy more? And so purchasing power parity is a really important function, serves a couple of really important functions. It's a really important idea because it helps us do a better job of comparing things like GDP and other economic measures across countries. And it helps us make sure that exchange rates are accurate. And we're going to tend to see it become really important. There's a great example of purchasing power parity that the magazine The Economist does. It's called the Big Mac Index, and it's basically trying to look at how accurate these exchange rates are by seeing how much of each kind of currency you would need to buy a Big Mac. And the idea is the Big Mac is a good that's sold in lots of different countries. It's generally made the same way everywhere, so it should have the same price everywhere. And so it helps us sort of break down the exchange rate and say, okay, does a dollar really buy as many Big Macs as 10 pesos or €2 or something like that? So why do we care about all this stuff? Why do you care about exchange rates? So we care about exchange rates for a lot of reasons. And this gets back to this idea of the central bank, right? The central bank in the United States is called the Federal Reserve, and the central bank is basically in charge of monetary policy, in charge of money, in charge of interest rates, in charge of keeping the economy stable, keeping it afloat. Changes in the exchange rate can affect the aggregate demand in an economy. It can affect our total productivity, our GDP. And if there are a lot of fluctuations in the exchange rate, it can be really disruptive for international trade, for investment, and it can be really problematic for our banking systems. And so like a lot of these measures, we really want it to be fairly stable. Fluctuations in the exchange rate, lots of appreciation and depreciation, is going to really muck up and be confusing for anybody engaging in any kind of international behavior. If it's investment, if it's buying and selling goods and exporting and importing, fluctuating exchange rates are going to make it harder to predict what's going to happen in the future. And that's just bad for business. So we try to keep our exchange rates fairly mellow, right? Keep them fairly stable. Financial institutions measure most international loans in a few of the major currencies. The US dollar is a really common currency to measure things in. We also see the euro is used a lot, and then the Japanese yen. The process of borrowing foreign currency and lending it in a domestic currency can work so long as the exchange rate doesn't shift. So the idea here is if I take out a loan in euro and I'm living in the US, I've sort of got that additional level of exchange built into my understanding. A fluctuation in the exchange rate is going to alter the rate of return associated with that loan and the buyback price of that loan. One of the most destructive effects of exchange rate fluctuations can happen in the banking system. So what happens here is when we have countries loaning money to each other, we can see that exchange rate fluctuations can make it difficult for entities to pay back their loans. So the individual version is, I take out a loan from a Japanese business person and it's denominated in yen. And if there's an exchange rate fluctuation, that's going to alter how many dollars I need to pay that person back in yen. The national version or the banking version is exactly the same. It's just scaled up. But when we scale these things up, the impact on the overall economy is bigger. And we can see the effects of countries borrowing money from international organizations and not being able to pay it back be really dramatic for those countries. So if we think about banking and international borrowing, we have this scenario here that kind of connects it all together, and we can see it be either a good story or a bad story. So We start up here with a bank borrowing $1 million in US currency and agreeing to pay 5% in interest. The bank then converts that to Thai baht. Baht is the currency of Thailand, at an exchange rate of 40 baht per dollar. So it's a $1 million loan that is converted into a 40 million baht loan. So the bank then lends the 40 million baht at a 6% interest so that they can make some money on top. After 1 year, the loan is repaid with interest. And so the bank receives the 42.4 million baht, 40 million plus 6%. Now, if the bank converts the baht back to dollars at the same exchange rate, they'll make $1.6 million. The bank then has to repay that $1 million loan plus the 5%, $1.5 million. And then the bank still has the $10,000 or the 400,000 baht left over to cover their expenses. On the other side, over here, what happens if when the bank gets the money back and converts the baht back to dollars, the exchange rate has changed? Now the exchange rate is 50 baht for a dollar. So the bank doesn't even get the original million back. It only gets 848,000. It still has to pay back the $1 million plus interest, but now it's taking a loss instead of making a profit. And so it's kind of like adding another layer of complexity and another potential for loss or gain in an international situation. We could think of it going another way too, right? If we get back to this part and the bank gets the 42.4 million baht loan, what if the exchange rate has depreciated and baht, it takes fewer baht to buy a dollar? Maybe if the exchange rate is 30 baht to a dollar, they would make more money and have a higher profit. And so it's adding another level of risk and another level of complexity and another potential for profit and loss by engaging in this international trade or international loans. So how do countries manage their exchange rates then? There's lots of ways to do it. And it's really on a spectrum. And that spectrum is between being really, really loose policies on your exchange rate, really, really flexible, and being really, really hard. And so the idea is, do you let your exchange rate respond to market forces, or do you put some restrictions on it? So a floating exchange rate is the freest, loosest version. And that says, hey, the exchange rate is just determined by supply and demand. We aren't going to manage it at all. You can get a little bit firmer, though, with what's called a soft peg. And a soft exchange rate peg is when the market generally determines the exchange rate, but the central bank can sometimes intervene to kind of boost or support the exchange rate. So the idea then is like, okay, well, we have a soft peg, but the US dollar is weakening in value relative to the peso. And so to solve that, maybe what the bank would do is try to reduce the supply of US dollars, right? Buy US dollars up from the market to try and support the exchange rate. That'd be an example of a soft peg. And we'll talk about this more as we talk about central banks, but the idea is the central bank has some things it can do to try and keep it in a general range that we want to be. There's also a hard peg. And a hard peg is when the central bank intervenes more often to keep the currency fixed. And so it's not another way to think of it is a soft peg would be like if we said, okay, well, we're fine with any exchange rate within here, but anything else we're going to correct. A hard peg would be saying, nope, we need our exchange rate to be 10 to 1. Anything else, we're going to correct it. The firmest or the most restrictive exchange rate regime is going to be merging currencies, using a common currency. This gets back to that list that I showed you at the beginning of the lecture. Adopting the currency of another country means, listen, I can't handle these exchange rate fluctuations anymore, so I'm going to give up control of my exchange rates and let another central bank handle it. Let someone else deal with it. And so rather than manage my own exchange rates or worry about my own exchange rate, I'm just going to dollarize, use the US dollar, or use another currency. And that way my exchange rate is fixed and based on the work another country does to manage their exchange rate, however they do it. And there's a lot of debate in the world of macroeconomics about the best way to do this. So like we said, a floating exchange rate is when the country lets the market determine the exchange rate. The US dollar has a floating exchange rate. And so a lot of the country actually has a floating exchange rate. Like it says in the book, about 40% of the world's economies use a floating exchange rate. They just let the market determine it. So there's no hard peg, no soft peg. It just is whatever the market says. The big concern with this policy is that it means there can be a lot of movement, right? You're letting the market make the determination, so you can wake up in the morning and something dramatic has happened that's altered the structure of your economy. Here we have the graph that shows US dollars in terms of Japanese yen. So how many yen does it take to buy a US dollar? And there's a lot of fluctuation. You can see here in the wake of the Great Recession, the yen dropped in value, depreciated relative to the US dollar pretty dramatically. But it's been relatively stable between 2011, maybe not 2011, I'd say it's stable from 2014 to 2020. There was a drastic depreciation in 2013, though, that shows this big change in how many yen it takes to buy a US dollar. All of a sudden, it goes from taking about 80 yen to buy a US dollar to taking almost 120 yen to buy US dollars. Since then, there's been a little bit of appreciation, and it's gone down to about 103 yen per dollar. And so the idea here is when this happens, when you have these floating exchange rates, you as a business person, as an investor, as somebody who is exporting or importing between Japan and the US, is going to be subject to these fluctuations and see that extra dimension of profit and loss play a role in your decision making. So a soft peg is when you let the market generally determine it, but the government's going to intervene a little bit. And so this is a policy where the government allows the market to set the exchange rate, but if there's too much movement in one direction or the other, the central bank's going to move in. And so, like I said, it could be them fixing a range, or it could say anything changing too rapidly will intervene, those kinds of things. And so it's kind of like it's like training wheels. We're going to let the market do its thing, except if it gets too bad. A hard peg is when the central bank says, no, listen, we need to have a stable exchange rate to have good investment, to be a successful country. And so we are going to make sure that the central bank ensures that we keep our exchange rate the same. And this can be really good for stability, but it can also be really expensive. It comes at a cost because then the central bank has to maintain that exchange rate. And that usually is going to be at the cost of buying and selling currency to influence the market. So here you can see some examples of a pegged exchange rate, and we're looking at dollars for real. And so this is looking at I believe it's the Brazilian real. And so here we've got our market situation, but the exchange rate is meant to be pegged either above or below the equilibrium. If the exchange rate is pegged below the equilibrium, where it's 30 cents to 1 real, we see that we're going to have an excess demand for the real, and the quantity demanded of real is going to be much higher than the quantity supplied by the market. On the other hand, if the peg is higher than the equilibrium, then we're going to see the quantity supplied exceed the quantity demanded. So there's more real out there in the market than consumers and investors really want. And then the last example is a merged currency, and that's when a nation chooses to use another country's currency, right? So dollarization is a great example of merged currency. But we see, as you saw earlier, there's other currencies that can be adopted. You could pick whatever you wanted. It does eliminate the risk of foreign exchange losses, but it also means you're giving up control over your monetary policy. And it doesn't always, I kind of take issue with this idea that it eliminates foreign exchange risk, because what it actually does is it gives you someone else's foreign exchange risk, right? They're going to do their monetary policy. If they've got a full market fluctuation, then you can get that too. What it does do, though, especially if you're a developing country or a country with a bad history of not managing your currency well, is it can lend some credibility and say, listen, hey, we've got it. It's okay. They're in charge now. We're not doing this anymore. And so it can kind of be a way to rehabilitate your country's reputation. So there is a great table in the book, real quick, I'll just show you, that talks about the trade-offs between floating exchange rates and soft pegs, hard pegs, and emerged currency, and just kind of talking about what would happen in different situations with those different exchange rate regimes. The last thing we want to talk about is what's called a Tobin tax. And so international capital flows are the flows of financial capital across national boundaries in the form of either portfolio investment or direct investment, right? So again, portfolio investment is going to be just sending the money, and we were talking about this at the beginning of the chapter, right? The different ways that you can send money to another country in the hope of getting a return. Foreign direct investment is purchasing more than 10% of the firm and managing it to some extent, while portfolio investment is just purely financial, just sending the money and hoping for the return. Tobin taxes are named after the economist, I'm going to forget his first name now. His last name was Tobin, and the idea was that it was his idea to tax capital flows. The idea here is to try to reduce capital flows in the hope that they would reduce the chance for big movements in exchange rates. And so it's kind of like an alternative to a hard peg or even a soft peg, where it's saying, listen, I worry that all these capital flows, these international capital flows, are going to have an effect on my exchange rate. There's going to be too much demand and supply fluctuation, and that could bring about a macroeconomic disaster. And so, in a sense, it's a way to limit the effect that outside individuals have on your country. And it's, any kind of tax is going to be a great way to make money also. But the idea is that it would reduce the influence of other countries on your economy. The reality is it's pretty difficult to get governments to impose these taxes, and there's no entity that can impose international taxes. You can have policies around international investment, but other than that, it's not very practical to impose Tobin taxes. So that's it. James Tobin. The economist's name was James Tobin. He's a Nobel laureate. I should have remembered his name, but in my defense, James is a kind of common name. It's not as memorable, so I'm going to blame him for that. Tobin taxes are not terribly common because they'd be hard to enforce. And also the reality is, just like with trade, international capital flows are actually usually really good for countries, especially developing countries. But the idea is it's another source of borrowing and lending. It's another source of revenue, and it's another source of economic development. And so the idea of limiting that is not great. All right, that's it. That's chapter 16. It's a complicated chapter. Maybe it's not. Maybe you like exchange rates and you are jamming on this stuff. This stuff I think can be a little bit complicated just because of the dollars for pesos and the baht for euros of it all. So try to take your time. Let me know what questions you have, and I'll see you next time. Have a great day.